Well, Jude, welcome back. This is our second episode now of
Episode 2
M&A Therapists.
is
Um, so I think today's topic we want to talk about EBITDA. I think it's a simple concept in theory, but actually when you look at it, it's a pretty complex thing. And I don't think people actually appreciate how complex it can be and how complex it gets in these deals. So maybe just to start, what is EBITDA?
yeah, EBITDA is just it's an acronym, right? So it's earnings before interest, taxes, and depreciation. And this is the metric that's used in the M&A world mainly for valuation purposes, right? So they take that EBITDA number, put a multiple on it. So it's 50% of the valuation, right? Like EBITDA is 50%, the multiple is the second half. The reason buyers use this and even sellers use this metric for valuation is because it's a proxy for operating cash flow, right? But it excludes things like the capital structure, which is, how is the company financed, equity versus debt, and then the tax profile, right? Because two buyers can have different tax profiles when purchasing a business, right? It can be an S corp, C corp, right? So a different tax exposure, and how it also excludes how the business invests its capital into capex, right? Some owners can be aggressive on the expenditure side. Can have a lot of assets, and some could be very lean, right? So that affects your depreciation. So, EBITDA just takes out all of that and then keeps it very clean and shows you what the cash proxy for your cash flow would be if it was not including any of the tax, capital structure, or these capex spend stuff. Keeps it clean.
Right. Yeah. So things that are, we'll say, choices certain businesses can make rather than true operating performance. So to your point, I can choose to invest a lot of money into CapEx, and I can choose the policy which I follow to depreciate those assets, and that gets picked up in your operating profit, but we add it back to EBITDA or to get to EBITDA so that we're undoing some of those effects. So I think that makes sense. And you know, what we see in the M&A world is there are many buckets of add backs in addition to the definitional items, right? So the definitional items are the ones that you laid out: interest, taxes, depreciation, and amortization. Um, but there's also a lot of other add backs. There's non-recurring, there are management adjustments, there are pro forma adjustments. So maybe help me understand what are some of those buckets, and what falls into them.
Yeah, I think we should start at how is even EBITDA calculated. So first of all, you should take your net income from your income statement, right? So your GAAP reported net income is always your starting point, right? And then you bridge to reported EBITDA with those acronyms that we just stated, right? So the first one is interest, and it can be interest expense and income. Next is your taxes. It can be tax expenses and like refunds you get to. You exclude all those, and your depreciation and amortization, right? All right, so you take all those three numbers, add it to your net income, and that's your reported EBITDA number. And you can kind of see that reported EBITDA for the most part, I would say 95+% of the time, should be higher than your net income,
Mhm.
right? Just because you are adding those expenses back. And I say 95% of the time because 5% of the time you could have those big incomes, right? Like in 2020, a lot of folks got the ERTC income credit or the PPP loan forgiveness. Those are incomes, right? So now your net income, seems very inflated, but really when you add those back, not very common scenarios. All right, so we get to reported EBITDA. Now this is where we start adding those adjustments back that like you stated, right? So like the first layer is those management adjustments. The most common one, that I think a lot of people do know is just owner compensation. Is it above market, under market, right? So you can, adjust your EBITDA based on where it's at. Second is like one-time non-recurring, items. Let's say you had a lawsuit, that's one time. You had a fire that burned the warehouse down, that's one time. You had a one-time professional, service fee paid, for an ERP implementation. That's considered one-time expense. Other ones are like personal expenses that the owners run, through the business. It could be your car payments, insurance, vacations, meals and entertainment, maybe, perhaps. Next could be, family compensation. You could have your wife working in the business, but not actively being a participant, right? So those are all, management adjustments. So you get from reported to management adjustment EBITDA.
Okay. Well, there's a lot to unpack there, and not to maybe get off topic, but as we just identified, that net income is one of the it is the basis for EBITDA. And so we almost need to take a step back and talk about how that in itself can be manipulated. And I think what we see, none of our small business clients have accounting policies, right? No one's documenting how their bookkeeper is actually keeping track of things. And that's actually where some of the manipulation of EBITDA starts, right? You can change, as we mentioned, your CapEx policy. Um, you can change your, AR reserve policy, right? What's your bad debt expense? You can change your revenue recognition policy, right? If we start recognizing revenue a little bit earlier and there's real reason to do that, you can actually just change your net income. And then in addition to that, yeah, we start adding back a lot of these seemingly arbitrary things, right? Um, you know, we see people a lot of the times try to add back meals and entertainment. Sure, that could be a legitimate add back, but it also gets conflated with actual business meals and entertainment. And so it becomes very hard to actually defend some of these add backs, right? And so everyone, especially on the sell side, their best interest is to add as many things into EBITDA as possible. And on the buyer side, they want to remove as many things from EBITDA as possible. So there's just this conflict from the get go. So I guess when we get into some of these adjustments, and we'll just stick with maybe this bucket of management adjustments, what support do you like to see in order to get full credit? On the sell side, what do we need to get an add back accepted? I guess is what I'm asking.
Yeah, from the sales side, one of the biggest ad backs that I see pretty often is the management compensation adjustment, right? So they're taking for the most part above market compensation, right? Salary plus bonus, which tends to be above what a operational CEO could be getting for a company of X size, right? So the support I would like for that is your payroll register. It can be ADP, Gusto, whichever payroll register, and then tying that back to your GL, right? So that's one. And then for like other adjustments such as one-time non-recurring legal expenses, what I do is I use the general ledger, right? So if the general ledger is showcasing this expense and it ties back to the trial balance, I use that as the basis because the general ledger is the most granular level of detail in the financial statements. So I think that's a good basis for your support. But if you want to go a layer deeper and be airtight, you would want to get some kind of invoice along with your adjustment so that it's like irrefutable
Mhm.
from the buy side.
Well, and I think you start to now see why having transaction level detail is so important because I think what we see a lot, we look at the general ledger and, for those that don't know what the general ledger is or what the trial balances are, general ledger is that database of transaction level detail that then roll up into the accounts, right, for the trial balances. And then those trial balances make up your P&L and balance sheet. So I think a lot of owners and honestly, a lot of people in finance who aren't accountants don't actually understand how all those things link together. So I think that's important to understand first. But yeah, what you're saying now is you're going to that general ledger where all the transactions are, and you are picking out specific expenses that we can add back, right? And so that's a much more refined approach than simply saying, oh, meals and entertainment was $25,000 last year. We're going to add all that back because there is, no chance that all 25,000 of that is truly personal or, not relevant to the business. And even if it is, it's very hard to just add entire line items on the P&L back, right? Would you agree with that? With the exception of maybe, let's say, owner's comp.
Yeah. I don't think it's very easily defendable at all if you're just arbitrarily adding back a single line item that you're seeing on the income statement, saying this is an add back, or even hard coding. Like I think it's very tough to defend those. They're not strong at all by themselves. They can be easily thrown out because of lack of support. So yeah, you shouldn't be doing that. And you brought up the point that that transaction level detail, how important it is. And you're right. I don't think many people know what's even going on in that database because it's such a large database, even for a single year. There's probably like over 100,000 plus lines of transactions. Each transaction is recorded, and each money movement in and out or transfers are also recorded in that database. And it has a lot of columns to be detailed as possible. And it's not increase decrease language either. It's in the debit credit standard, right? So now you're getting into more accounting, and some people get confused of these debits and credits. Not to get off topic, but you know in the accounting world, revenue is a credit. So if you look at it in accounting language, it's actually negative,
Right.
right? So people are like, "What's going on?"
Right.
So yeah. So I concur with you on the
Yeah.
the difficulty of the transaction level database interpretation.
As the non-CPA in this conversation, I agree, and to this day, it still takes a second for me to be like, "Wait, is this a credit or a debit?" Um, okay, that's great. I think one of the other buckets that we can talk about, which I always just find kind of funny, is the pro forma adjustments. And I've got a couple of good stories that I can share here. But maybe before we get into the stories, we can just talk about, yeah, what is a pro forma adjustment?
Yeah, pro formas, typically come like right at the bottom of your EBITDA summary table, right? So you have the definitional right at the top, definitional adjustment right at the top, because those are very easily defendable. Then you have those management layer adjustments, which are below that in the middle, okay. But then the pro formas are like beneath that, saying, and it'll have a total line that says pro forma adjusted EBITDA or something like, along those lines. And these adjustments are not grounded in today's reality. They're either forward looking and it's a what if scenario, and the either QAV provider or the M&A advisor is taking those forward looking what if scenarios and projecting them to the future, or even projecting them into the current period and your past historical periods, and showcasing to the reader, what if this scenario happened today, EBITDA would be 50 times, 20 times higher than it is today because of this future event that has not happened. So it's not defendable at all. I would say it's very hard to defend, especially in the low middle market.
Yeah.
Without proper data, forecast, budgets to like really showcase like, okay, this is our track record of operations. So yeah. What else is EBITDA used for, do you think, in a deal scenario besides just overall headline price? Is it used for anything else at all?
Yeah, well, we see it a lot in earnouts. So an earnout is essentially, I don't believe that your business is necessarily worth $20 million today, but if certain things happen or certain growth initiatives come true, then sure, maybe it is worth $20 million, but I'm not going to pay you for that today. I'm going to hold back a piece of the purchase price. And if these thresholds are met, then I will release that additional amount of funds. Um, but now you need something to measure it by, right? And EBITDA is usually one of the common measuring sticks. So if we don't have a clear definition of EBITDA, it becomes very hard to define the measuring stick. And again, on the sell side, we want it to be written in a way that allows us the most flexibility and the highest possibility of achieving said target. And the buy side is going to throw, everything in the kitchen sink into the definition that can keep their options open to manipulate EBITDA. And, we'll see it as part of the purchase agreement, right? There is a definition for EBITDA. It could be 3 or 4 pages long, right? And there's a number of different things that will be or will not be included. Another area is for bonus targets, right? If you're an operator, you're planning to stick around for 2 or 3 years, and you might have a base salary and have compensation tied to performance of the company. A lot of the times, it's EBITDA. And, so it's really important to spend a lot of time getting the definition right and understanding, like, what actually you are signing up for.
Yeah, and one other thing to add is like just the overall debt covenants, right? We have a deal right now where the independent sponsor is underwriting the DSCR off of adjusted EBITDA, right? So even though I think that position is maybe slightly flawed because again, EBITDA is not operating cash flow. It is a proxy. You are not taking into account your working capital, your capex, your taxes. So there's a quite a larger delta there that could happen just depending on the just the operation of the business, right? So yeah, but debt coverage is also one of the key factors that EBITDA is used for.
Well, and I think that's, you raise one of the biggest limitations of EBITDA, and that is you are excluding, in people's perspective, you're excluding real expenses to the business, but not including those in EBITDA. And where we see this is, I'll give an example. A consulting business with $5 million of EBITDA has a very different cash flow profile than a manufacturing business with $5 million of EBITDA. And the reason for that is a consulting business, they probably don't have capital investment. They probably have a pretty simple or not very capital intensive working capital cycle. Whereas a manufacturing company, they might spend $1 million a year on new equipment. They might have, couple $1 million in accounts receivable at any given time. They might have a couple $1 million of inventory at any given time. And so when you actually take out the changes of EBITDA less your capex, less the changes in working capital, you might have 3 million of cash flow, where the consulting business still has $5 million of cash flow. And so I think that's why a lot of people push back on, oh, it's not all about EBITDA. I tend to agree with that, but it does still serve a very powerful role in the process of selling a company, because you can put a consulting business and a manufacturing business and try to, you know, exclude some of these other things to put them on an apples to apples basis. But in that example, it really isn't apples to apples basis, right? And help me understand, I think CapEx is fairly straightforward, right? If I buy a piece of equipment for $1 million, that is maybe cash coming out of my pocket today. But because I can use it for more than a year, I can put it onto the balance sheet, and so therefore it's not a expense on my P&L today. I think that's straightforward. But maybe spend a minute or two talking about how the change in working capital impacts cash flow.
Yeah. So first of all, like for this, purpose of this conversation, working capital is just gonna be like three main accounts that most people are familiar with: accounts receivable on the asset side, inventory, and accounts payable. Right. So and these are all balance sheet accounts. And I will say working capital is a l- little bit of a tougher concept to grasp. I'll try to make it easy as possible. So let's just talk about AR, for example, right? So let's say, 1 month you have an AR of 1,000 uh, is is your balance, and then the next month it's 3,000. So obviously it went up by 2,000, from month to month. So if you ask a person like, okay, AR went up, what happened to your cash flow? It's a 50-50 answer. Did it go down or did it go up? So the answer is your cash flow actually went down because, in accrual accounting, you are recording the revenue, but you haven't collected yet. So that is a change in working capital concept right there. Your AR went up from one period to another. So basically, your cash flow went down. Very counterintuitive for like a regular person to understand that. Same with inventory. Your inventory went up means your cash flow went down because you bought that inventory, right? Okay. Now what about accounts payable? So let's say you owe your vendors again 1,000 today, and then a month from now you owe them 4,000, right? So now your balance you what you owe to your vendors went up by 3,000, right? Okay. Now, did your cash flow go up or down? Just based on the working capital concept, your cash flow actually went up,
Right.
right? Because you incurred that expense, but you actually haven't paid them, right? So you can see now when assets, the asset side of working capital is treated a little bit differently, AR, and then the liability side is treated differently depending on if it increases or decreases.
Right. It's completely counterintuitive.
Yeah.
You think that because I made a sale, because revenue went up, that I should have more cash in the bank. But with accrual accounting, that's not the case. Your revenue went up, but I'm actually lending that customer money. And the same is true for the payable side, where my expenses went up. So that feels like it should be less cash in my pocket. But because I actually haven't paid them, I still have that money. So they're actually lending me money. And so that's an area where I think a lot of small business owners, it's an easy area for improvement. A lot of these owners, they don't like to have debts outstanding, which I appreciate, right? Everyone likes to pay on time, and that's great. The problem is they're actually not paying on time. They're paying in advance, right? If I have 30-day term, if I get a bill and say, "Hey, pay me in 30 days," a lot of owners will say, "Okay, I'm going to pay you today because I got the bill." When in reality, their vendor is extending them a 30-day free, interest-free loan, which I think people should take advantage of more.
Yeah,
So,
exactly.
okay. I know we got a little off topic with working capital, and it's funny how working capital always seems to make it back into our conversations. But
Yeah.
it's one of those things where the financial statements are connected in many different ways, and in these M&A deals, I think a lot of people don't appreciate how changing one area of the financial statements has a effect on another area. And when evaluating these deals, you have to actually play out the scenario and understand how does each change impact the whole picture, not just the one, you know, piece that you're really thinking about today.
Yeah, I think just on that, right? Certain EBITDA adjustments actually have a similar impact on the working capital side too. Like you make an adjustment on the EBITDA, in your QAB, and it affects your adjusted EBITDA now. But that's actually another one-to-one adjustment happening on the working capital side. So an example I can give you is think about your bonus expense,
Mm.
right? So most companies just pay their employees an year-end bonus in December for the let's say for the calendar year 2025, right? They make that payment and then they expense it in that current month. So, let's say you have a relatively, stable payroll months from Jan through November, and then you have a massive, increase in payroll in December. Now, what should have been done is, the company should have done something called an accrual, which means, let's say we are forecasting of paying $120,000 in bonus in December to all our employees. So the outflow is 120,000. Now, if you already know that ahead of time, you can start accruing that starting in January.
Mhm.
So that means in January, you book an expense for 10,000.
Mhm.
Now, obviously, no cash flow is coming out, right? So what is the other side of the entry? It is one of your working capital accounts. It is your accrual. It is your bonus accrual, which is a liability. So month to month, you are booking that expense, but your liability is also increasing month to month. So that now it's a working capital impact. Now, but come December, when you pay it off, that liability falls to zero.
Mhm.
So that is working capital. Typically in the QAV process, the QAV provider will make that adjustment within their model. It's
Mhm.
not in the accounting system, but it's made in the model, and it has an impact on your valuation and your working capital.
Well, and you're highlighting a really explicit example of how EBITDA cash flow might start to break, right? And this is why you do need to really consider the change in working capital in your free cash flow number. Because in that scenario, let's say, yeah, $120,000 of bonuses paid at the end of the year. I am expensing $10,000 per month for 12 months. And that is lowering my EBITDA, but it is actually a source of cash for me as an owner because I'm not paying out the bonus, right? So it's basically like it's true compensation to your employees, but you are essentially borrowing that money from your employees for the entire year. And so, it's just these are the nuances that we deal with every single day. I mean, it's just one giant puzzle, right? And when you get into these quality of earnings scenarios, our job is to play out both sides, right? What perspective is the buyer going to take and what is in their best interest? What perspective should the sell side probably take because it's in our best interest? And then I'll actually say there's a third bucket, which is what is the intellectually honest approach? Because I think both the buy side and the sell side tend to skew in a certain direction. And the hope is that, we can just find a deal in the middle, which we think is the intellectually honest approach.
Yeah. And again, like three things are happening in that example that, we just presented, right? Your income statement is being impacted at a certain time of the year. Your balance sheet is being impacted in a certain time of the year, and your cash flow is being impacted at a different time of the year.
Mhm.
So it's all these levers moving at different times of the years in different dollar amounts. So like you said, it is a puzzle, and there is a method to the madness. But if you are not familiar on how all these cash and accruals and expenses and the three statement financial models interact with each other, you actually can get lost and like actually make a mistake that would could cost you your client a material amount of their business, right? So yeah, we can reiterate enough how important these topics are.
Well, and, I think we're getting into why cash accounting versus accrual accounting are what they are. And a lot of our clients and a lot of small businesses are on cash basis. Why? Well, they don't need to know debits and debits and credits the way you do. They don't need to really account for all of these changes in the three financial statements, right? They get a check for $100,000 and they say that's revenue and it goes into the bank account. But the issues that you inevitably run into is, well, what do I actually have floating around out there, right? All of those invoices that are floating around outstanding. Cash basis doesn't actually account for that.
Yeah.
Same with bills, right? If I have, bills that are floating around out there that haven't been logged, what do I actually owe? And I think this is how a lot of owners who are on a cash basis of accounting can run into cash flow issues because they're not actually understanding how cash is flowing through the business. They're simply looking at the P&L and being very reactive to these are the inflows and outflows of cash, and that's what's being reported versus, understanding what is actually happening in the business and when can I expect the cash to flow through the business. I think there's very, very different things.
Yeah, like one of the owners actually, told me, at the end of the year, they actually just take a, distribution, aka like a dividend out of the business, and they do that just looking at the P&L, just overall seeing what the performance was like for the year, with the assistance of their, tax CPA, by the way, and then at the end of the year, they also look at the bank statement and decide, all right, we can take out X dollars as a distribution, let's say 100K, distribution. But one of the things he mentioned to me was when looking at the bank statement, he doesn't know off that bank balance on December 31st, how much of it is profit and how much of it is like working capital, meaning
Mhm.
customer deposits that have been, put down, or vendor deposits that need to go out, or, or other items, right? So he was just arbitrarily trying to take a distribution which will have cash flow impacts to his business in the following year at the end of this year. But yeah, they don't have any visibility into the overall working capital mechanics, which I think is like for his business was like a material aspect of
Mhm.
the cash that sits in the bank, but he had no visibility, and he was basically just shooting, just closing his eyes and throwing dart at the board and be like, okay, I hope I took enough to have liquidity in the following year.
Right. Well, and now I'm starting to get out of my domain as a non-tax advisor and someone that's not licensed to provide tax advice. But, um, if you're looking at the your balance sheet, you're looking at how much cash you have in the business, and you don't actually know how much of that is truly retained earnings, right? So profits of the company, and you start taking out more money than you actually are able to take out from a tax perspective, you can actually create a pretty significant tax liability for yourself in that scenario. And so again, these are some of the inner workings of accounting and finance that when you're in the day to day running the business, you're not thinking about these things, but they usually get surfaced in an M&A transaction because someone's going through it with a fine tooth comb and saying, "Hey, here's actually how the money flows through your business. Here's what the cash flow of your business actually is. And oh, by the way, here's the tax implication of that cash flow and whether or not you've been following it correctly." So it's a giant puzzle, and I think that's what makes us get up in the morning and keeps us interested, right?
You're right. I mean, listen, like today was a great conversation. I think we covered a lot of a lot of items and topics, and this is why when a seller is going is getting ready to sell, a competent M&A advisor is like so important, right? And I think you mentioned in episode one that M&A advisors, good M&A advisors tend to be expensive, and and they cost money, and I think it's you know, applicable to the sellers to spend that money because this is a top three life event
Mhm.
of selling your business. And one other icing on the cake, I will say, on why you should pay an M&A advisor and it won't impact your value. The M&A advisor fees are you can add that back to EBITDA.
We love
We
an add back.
we love an
We
add
we
back.
love transaction expense add backs. Those are ironclad. We can usually get those. And, yeah, I mean, like, as you said, the deals that we're working on, these aren't 5,000 or $10,000 items, right? I mean, we're talking about 250 or $500,000 items, and there's a laundry list of them. And yeah, you make a mistake on one or two of them, and you're in the hole. Could be $1,000,000. So maybe I'm a little biased. I think we definitely earn our keep, so to speak. But I agree, this has been a great conversation, and I'm looking forward to doing it again next week.
Great.
Awesome.
Fun. Thank you, sir.